Bum, 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 bum. Hey, hey, hey. So every day we lit. Back at it again. Back at it again. Hit the back at it again. So we lit per usual on this beautiful financially lit Tuesday. Every day we lit, but especially today. You know, you know how it goes. You know how it be, and I'm logging onto the Instagram per usual. All right. So hello, everyone. Okay, I got y'all already tuning in. We lit. Okay. Say hey. Don't be afraid to comment. Let me know that you are with me today. So we're gonna be talking about debt. We're gonna take a debunk some myths that's been going around. You know, things that we over the years kind of came to believe that that's what's accurate when it comes to managing debt or using debt as leverage or whatever the case may be. So I'll be going over all that good stuff today. And then I'll be talking about stock splits because we got a couple of huge stocks that just split this past weekend. Really, kind of, a little bit. But so I'm going to be talking about those both so that we could, of course, per usual, if you have any questions, let me know. And yeah, so to start us off, we're going to be talking about this. I do want to mention that, of course, if you have any questions at all on or off the live, of course, I want you to interact and engage while I'm live. But if you do want to speak to me or any other of my associates offline, you can book a free consultation at grandmanfinancial.com. Hey, Amy. Yes, so we're going to be talking about myths today because, baby, I'm gonna start off with cars because you know we think that we gotta have the nicest, flashiest car, and you know what? I'm a victim to that because I sure enough went got my car straight off the lot, 2014, college student, swimming in debt. I wasn't swimming in debt just yet, but hey, Nikki, I was on my way. You know, I was girl, I mean, come on, let's be serious. And then 2014, I got my car brand new, fresh off the lot. I was lit. And long and behold, you know, over the years, you think about how much money you're spending on that loan. And I was at a ridiculous interest rate, like 8 something percent, right? And it took me five years to pay it off. Right. And I went through a period in college where it was rough. So I missed a few payments. Look, but God. But I do want to talk about, cars because a lot of people feel that, oh, I have to buy something new and fresh off the lot because it's what's safe. It's safer and it's more reliable, right? But we don't understand how much debt we're putting ourselves in. We don't understand how much of a setback it is. The average millionaire, the cars are 3 to 4 years old. What does that tell you? Like, millionaires, they the ones that could buy fresh off the lot. They're not even buying brand new cars because honestly, it's not worth the amount of money fresh off the lot. Because as soon as you drive off, 6 months later, it's you already lost 20,000, not 20,000, but more than half the value of the car. So really making sure that, hey, like get a used car, even if it's a couple of years old, it's completely fine. It's still reliable. It's still safe. Like I said, average millionaire is driving a 4-year-old car. Like, don't play yourself. Don't do it. I know you want to, nah. Okay, it's okay. You can still be lit with a older model. Um, but you are making the car salesman very happy. Um, Also, I do want to touch on like families because I know when it comes to, I don't have children of my own, but like a lot of people say, like, I want to make sure that my kids have everything. Like, I want to make sure that they don't have to like struggle or suffer. And a lot of times it's because of your upbringing. Sometimes, like, as you go through so much struggle growing up, that you're like, you know what, this can't happen to my kids, and you wind up giving your kids everything. You're like, yeah, or you like, now you're the go-to person as far as if somebody needs something in your family, whatever the case may be. But you also end up, in a sense, putting yourself, setting yourself back, because now you have to keep up with all this that you're giving to your family or your children or whatever the case may be, and without actually taking the time to build wealth, right? Without taking the time to say, hey, am I putting my money in the right places? So you definitely want to make sure that, yes, you want to provide the best for your children, but we want to work smarter, not harder, and set ourselves back trying to do the most. The other thing is that we can save later. Um, you're going to retire whether you know it or not, and the government is not going to fund your retirement. Like, yes, you're paying into Social Security and Medicare right now, with every W-2 you receive, and even self-employed employed individuals, you're still paying that on self-employment tax. Like, but you cannot rely on that, and it's never too late to save. In fact, saving early is the best thing you could do. Save as soon as possible, like right now. Not only does it help interest wise, and I break down the rule of 72 all the time, which is like a cool, quick trick as far as what you can use to kind of see how much interest. Hey, Adrian. How much interest is developing on that money. But also, you want to make sure that, hey, you're saving so that when it's time to retire at 60 years old or however age you want to retire. Most millennials want to retire in their 50s and 40s. How is that going to happen? I don't know. But in their heads, like, it's going to work that way. So, but really making sure that you're saving money as soon as possible, and you're not linking your savings to your immediate checking account. It should be in a totally separate account. You shouldn't even have like direct access to it. You want to make sure that it's kind of like out of sight, so that you're piling up that, you start piling up that money. Not only do you have that rainy day fund that's remaining liquid at all times, but you also have that savings that's gonna provide an investment funnel later. So whether or not you're like, hey, I want to invest in this vehicle or that vehicle later, you have that group of savings that you could dip into, and then you have your rainy day. You want to always keep your rainy day fund. Excuse me. So another is, that your credit score is everything, right? Like, credit score, yes, is important. Like, you can use it with a lot, but a lot of people get carried away, especially with managing the debt as far as the credit goes, because then you're like, yeah, I got to build credit, I have to get a credit card, I have to do this, and I have to spend money on it. But a lot of the times we end up setting ourselves back. So really making sure that we're not concentrating so hard on the credit score, and thinking it's the end all be all, because it's really not. Cash is king at the end of the day, because if you walk into a store and you said, hey, and you're buying, say, a computer, right? And they have a financing available. They say, hey, with zero money down, you don't have to put any money down. And you know what? It's interest free. But you're going to be paying, and they do it with cell phones. Oh, I'm going to use a cell phone instead. Apple, right? Since I'm going to get into the Apple stock split later. So Apple says, hey, come get a new iPhone. We got you. Don't worry about it, sweetheart, right? And then they say, hey, it's $1,000 phone, but all you got to do is pay us $30 a month or $45 a month for the next year or 2 years, and you can have the phone. But what you end up doing is paying more for the phone versus you just saying, hey, I'm going to go and purchase the phone at $1,000. So now you're like, hey, $45 a month for the next 2 years. Oh, we lit. Uh, $45 a month for the next 2 years. Oh, that's great. But you end up spending $1,100 versus spending that $1,000 or even nine something. So that's money that you could have saved. That's money that didn't work for you. You had to work for that money to make sure that you purchased that phone because you wanted to spend $45 a month to purchase the phone versus cash. Right. At the end of the day, cash is king. Yes, these interest-free financing, things like that, they all work the same because at the end of the day, if you're going to walk in there and pay it out, right, it's always going to be less than if you use the financing option. That's how they make their money, even when they stay zero interest. Um, I got my got my tea today. I be thirsty, y'all. Hey, hello. I want to make sure let me know if you have any questions as I go. Another one is like, why should I strive to, increase my income or, oh, wait, before I get that to there, I want to touch on this one. Income. The other, I really want to make sure that I touch on income, reducing the amount you're spending versus increasing your income. So I assist people with building the right budget for them. That's what we do at Grand Rev. Like we make sure we tailor the budget to the individual because every budget is not going to work for every person. It's like going to the doctor. You can't just give them a fix-it-all pill, right? Like it doesn't work like that. So you cater the budget. You're like, hey, you're nitpicking. You're like I'm going to cut off Xfinity. I'm going to do this and do that. Or I'm going to stop buying coffee and only do it 2 days a week. Those things are good, like habits to keep and things like that. But at the end of the day, increasing your income is really going to, that's going to make get you to building wealth faster. You can penny pinch all day and night, but what's going to actually make the difference is you building that other stream of income, that stream of revenue that's going to come in, that's going to increase your cash flow. Penny pitching and cutting out the small things are going to make very subtle changes, but a lot of the times we end up cutting those things out and reallocating that money to something else. I did a whole live on budgeting. Go back and look at it because you're not going to build wealth without a budget, a monthly budget. At the end of the day, it's just because you're not telling your money what to do. If you're not telling your money what to do, it's going to do whatever it wants. And then you're going to look back and be like, yo, where did all that money go? Did I really make $60,000 this year? How? Did I really make $40,000 this year? 45? People say all the time, they don't realize all the money that comes through their hands. In an average lifetime, we go through $2-3 million in an average lifetime. Where does all that money go, right? This foolishness, like we don't care, we lit. The other thing I want to touch on is like, because I touched on building that revenue stream, a lot of times people are like, why when the government is going to take it in taxes? Like, I don't want to do that. I don't want to pay a bunch of taxes. But what it does with, one, make sure that you have a tax preparer, a tax strategist that's going to give you a great strategy to minimize your taxes, your tax liability. But on the flip side, you're increasing your ability to build wealth over time. So and I love using married couples as an example because it is one of like the quickest way to build wealth. Not only do you have two revenue streams, you just double the amount of money that's coming into the house. Say your husband makes $50,000 and you make 40 or 50 as well. You both together are making six figures. Like, what do you do with $100,000? Right? So making sure that you're building income. Now that you have $100,000, you're not nitpicking at the $7 you spent on coffee yesterday because you have an extra, you have another source of revenue stream, right? So making sure that we're increasing our income. The other is insurance. Insurance, I feel like there's a lot of people out there that believe that I don't need insurance. Oh my gosh, it's a waste of money. Um, but then they're like, oh shoot, I wish I had it when something happens. Making sure that we like term insurance is very cheap. Like it's the cheapest insurance that you could get for a high death benefit. Like, I mean, you pay $50 a month for a $500,000 in death benefit. Like, get you something like that. And I'm just throwing out numbers out there. But, get you something small, get you something that's gonna at least grow your wealth over time, or something that you could pass down to, the next generation. Even if you don't want to do a whole life, or a variable life insurance. Make sure you're getting insurance, health as well. Um, you want to decrease those high premiums over time. Um, and then the other I want to end off is that you will always be broke, or that, hey, this is just what it is. And I wanted to make sure I touch on that, because building wealth is a mindset at the end of the day. If you don't believe that you're gonna make it happen, then it's not gonna happen. So making sure that, hey, Autumn, making sure that we're taking the time to say, hey, like, be intentional about what you want. If you want to build wealth, then you have to have that mindset. Not that, oh, money is the root of all evil. Not that, oh, the rich are snobby and they just care about themselves. Remove that from your mind, because if you keep that mindset, you're always going to remain in this same social economic status that you're in. Hey, Candace. So really make sure that you're removing those things that are clouding your judgment, that are keeping you from achieving abundance and wealth in your life. So, money's not the root of all evil. Money is a tool. Okay, money allows you to make life more enjoyable. It allows for you to live a more freedom-filled life. So really making sure that you put in those positive affirmations, that when it comes to money into your life, and not, oh, I'll always be broke. Oh, it's just how we always did it. Um, let's let those go. Let me know if you have any questions. Hey, Dana. Oh, Diana. My apologies, Diana. I'm pretty sure it's I read it way too fast. And hey, Rosanna and Audrey and Daniel. Point A to point B, that's it. Yes. Trying to make sure I keep up with the comments. Okay. All right, cool. All right, now I know I went pretty fast over the myths, the debt myths. Of course, there's a lot more. There really are. I can go on for days, but I wanted to keep it relatively short. But I do want to get into stock splits. So, some people already heard of it, and they're like, okay, but it is, a financial term that I want to make sure that you all have some basis around, or understanding. Candace, she asked about the Apple stock. I think it's awesome. But I want to explain what a stock split is before I touch on the Apple stock. So what a stock split is, it's when it happens, the stock is worth the same, is worth a lesser value. But say the person owned 10 shares we'll do one share to make it simple. So say they own one share of Window International. I want to use a stock that's not out there, so y'all not confusing the numbers. So Window International is worth $1,000, and they said, "Hey, we're gonna do a 1-to-5 stock split." What happens is I own one stock of Windows International. My one stock now is 5 stocks, but it's still worth $1,000. But now I have 5 pieces of paper. It used to be pieces of paper back in the day, but now we got internet and all that good stuff. They don't give us pieces of paper anymore. When we own stock, they just say, "Hey, you own it. All right." They give us your little receipt in your email, but they don't even do that really. They just say, "Oh, you own it," and then Fidelity sends you an email. that you bought of stock. But what happens is now you own 5 pieces of paper that's still worth $1,000. But each piece of paper is worth $200 each. So say we're like, okay, I want to sell one of my pieces of paper now worth $200 each. And I sell one, now I have $800 worth of Window International stock. So what Apple did, they said, hey, this is not the first time that they did a stock split either. But this is like when companies do stock split, you have to kind of like, you have to say like, hey, like, what's making them do the stock split? Do they have something in the wig works, or are they like, definitely look at who's in management. But as companies like Apple are not going to fail. Apple and Tesla just did a stock split. And those are the companies that I'm going to touch on right now. So Apple stock split, they were sitting around like who were they at? You would think I'd have that number already. Bad, y'all. I'll do Tesla since I remember that one. So Tesla did a stock split for they were worth $2,000, over $2,000. They did a stock split. Now each of their stocks are worth around $500. Now, just like I said, the person that owned one of Tesla, it's worth the same amount of money, but what happens is everybody gets excited about the stock split. They're like, ooh, they did a stock split. So non-investors, experienced investors, what they do, they buy and then they jump right out. So it's going to make the stock very volatile. So during that time period, there's going to be a lot of fluctuation as far as how much the stock is actually worth, because you have a lot of non-traditional traders coming in, or non-experienced traders coming in that don't really know how to trade or what they're doing. So they're buying and selling really quick, or they're making like $5 or $10 on a stock and then selling. So you will have it like where it's fluctuating a lot. But like if you're not trading a lot of money, it really doesn't work in your favor, because you just let go of a stock for not that much of a gain. But outside of that, so Tesla was worth $2,000. They said we're going to do a stock split. We're going to do a stock split. Now they're worth $500 each. So they did a 4-and-1. They did a 1-to-4 stock split. And then we're like, hey, Apple's like, hey, we're going to do a 4-and-1 stock split. So now it increases Apple's buzz. So people are like, oh, shoot, I got to get me some Apple. Apple's a company that, they're not going to let fail. Like I said, Tesla's another one. So it's a great buy. Definitely, I would highly recommend it. And I don't really like telling people what to buy, because then they're like, oh my gosh, you led me astray, how dare you. But at the end of the day, gotta take accountability, y'all. But yeah, so like Apple's like, yeah, we're gonna do a stock split. They did a few throughout the years. We're gonna do another. They're talking about it. So that helps with the increase as far as how much it's worth. So when you start hearing buzzes about stock splits, usually the stock goes up, because people are like, oh shoot, something's about to happen. So yeah, that is basically what a stock split is. And as far as, definitely take a look at Tesla and Apple, because they are, doing the whole stock split thing, and they're making moves out here, and it makes it more affordable for the lower income person to invest in these stocks, because who's about to drop $2,000 on Tesla? But now you're like, okay, I could drop possibly $500 on a Tesla stock. So it does make it more attainable in a sense to purchase one of their shares. Yeah. Any questions? Let me see. to make sure. And all right. I really when it comes to managing when it comes to managing Facebook Live, you would think I would know more about it by now. Okay. So yes, that's really anything. I don't have any questions out here. I did talk about Miss and the stock split, Apple stock. I do think they're both great buys. I got me some, of course. And the thing about stocks is a buy and hold game. If you're looking to come in and come out, it's really not your cup of tea because it's a long haul game. You really have to like buy and hold and watch it work. If you're doing like, if you want to do quick trading where you're doing in and out, then get into Forex, get into option trading. Stocks trading is really a long haul game. You're really going to have to sit on the stock for some time. It's not something that you're just going to buy and purchase within a day or two unless you're trading a lot of money. If you're coming in at 10,000 and then you're watching it, you're coming at Apple right now because from yesterday to today, Apple already went up more than $10. I think like $15, right? $15 in one day. Now, for the average Joe, they probably could afford one or two stocks, which means they got a $30 gain, which is still good because if you put their money in a bank or somewhere else, that return on your money is a lot better than you would have gotten on that hundred. I mean, that $130 anywhere else. But in that same regard, if you're trading $10,000 and you bought that amount, now you have 10,000 times $15. Now that is where you see more of a gain. Um, So it's really for like the big wigs if you trade and you're doing quick trading, but even they buy and hold. Um, yes. Any questions, y'all? And of course, the recording will be available on the Sipping Wealth YouTube page. So if you are not subscribed yet, definitely subscribe to Sipping Wealth YouTube. A lot of the videos are on there. Still adding the old Financial Lit Tuesdays on there, so eventually you'll see them all on there, and other things as well. Um, uh, but yes, any questions about debt, about stocks? Do you have any thoughts on index funds that may have lower per share cost than the S&P 500? Yeah, so index funds, if you're starting out trading, index funds are I don't even know anything better to get into other than index funds when you're starting out trading because they're the safer and then like a less boggled down because indexes like the S&P, they literally take the best of the best companies, put them all in a package and say, hey, you can buy a portion of all these companies doing well, like buy into my portfolio. The S&P is like a portfolio of a bunch of great companies and if a company starts slipping, they kick them out of the 500 and they bring another company in. So it's probably one of the like safer ways of saying, hey, at least I know I'm going to get a return because they only pick the better companies to trade on index funds like NASDAQ. They don't just like, hey, I know you come on board. They make sure that the company is doing relatively well. Yes, companies go up and down, but if it goes down to a certain level, they kick them out of the fund and then they replace it with a new company. Um, So yeah, it's index funds is really where is a great way to start with trading. I have lost money trading, and I remember my first stock I bought into was the Dropbox. I bought into Dropbox. It was an IPO. I was like, ooh, I'm in college. I'm taking my little finance courses. I thought I knew a little something, right? All big headed. I'm like, oh yeah, I'm gonna go. I believe I put about $400 on and Dropbox, and then I was like, oh, feeling myself. It was doing a little good, and then Dropbox like plummeted. I basically I lost like majority of the money that I put into Dropbox. But I haven't sold it. I actually keep it as a reminder of when I failed, when I like fell on my face in trading because I thought I knew it all, and I was just like, I'm so ready to start trading. And I fell flat on my face, lost so much money, and I keep it to this day. And I look at my investment account and watch how terrible Dropbox is doing as a reminder. Um, and it kind of keeps me on my toes to make sure I'm doing the right research on the companies before I go ahead and buy it. Do I still have I lost money on stocks since? Um, no. That was the biggest L. Am I down on a stock? I'm down on two stocks right now, but um, I have had hopes that they will go up, especially when oil goes back up. And who else is in there? Disney's back in the green. Yeah. So, um, but yeah, Dropbox was my L. Any other questions? Hello, Nicole makes moves. That's a cool name. Let's see. Yeah, I don't want to make. Okay, I'm coming up on 30 minutes. Cool. So yes, I in the beginning of the video I talked about the myths, talk about stock splits. If you do have any questions, feel free to book a free consultation at grandrevfinancial.com. Um, Grand Rev is hiring. We are hiring tax agents and a new admin. So really excited for the season to come. Definitely excited to train some new agents to help you all. And yes, and then two workshops are going on are happening later this month. So make sure you keep an eye out. There'll be promotional material coming out this week. So, for the two workshops, we're going to be talking about business and how to build a business. What are the steps to take? Because I do have business owners that are in business and they're like, so I just went and started a business. I don't actually know like what's the legal stuff and the financial stuff of the business. So we're going to be getting to all that in the workshop. Of course, we're going to do the nitty gritty. I mean, people pay me like $400 or $500 to get their entity started, but I'm hosting a workshop to basically show you how to do it yourself, and to show you the different steps on how to manage the startup and what to do financially. I'm gonna bring in a person to talk on the legal side of things that to do. So, and then we're going to be the second workshop is business credit. So how to establish business credit, how to grow it. I have a credit specialist as well that's joined me on that workshop. So those are two lit workshops that are going to happen this month. I'm very excited for it. Um, yeah. So make sure that you're booking your consultations. If you have any questions or sending us a direct message, let us know. Let's wealth up together, and y'all have a great financially lit every day we lit Tuesday. Let me make sure before I get off that I answered everything. Oh gosh, yeah. All right. Hey Janice, and that's it. Good night, everyone. Hey, there, he lit. Hey.